Welcome, and thanks for joining us. This discussion has been put together by the expert tax advisors at My Tax Accountant, one of the UK's most trusted accounting firms. We're going to get into a question that could really change how you plan for your future.
So let's start with this. Do you think you're stuck with just one pension pot for life? It's a really common belief, isn't it? Especially for entrepreneurs and freelancers. That kind of thinking could be seriously limiting your retirement savings.
Well, here's the surprising truth. There's absolutely no legal limit to the number of self-invested personal pensions, or SIPPs, you can have in the UK. That's right. But, and this is a big but, there's a lot more you need to know to make this flexibility actually work for you.
So let's break this down. We're going to walk through what a SIPP actually is, explore the pros and cons of having more than one, cover the critical rules you absolutely must follow, and then look at when it's time to call in the experts.
Okay, let's dive right in. Before we can even talk about having multiple SIPPs, we need to be crystal clear on what one is. Think of it as your retirement power tool.
So a SIPP gives you control. Unlike a standard pension where the provider pretty much manages everything for you, a SIPP lets you pick from a huge range of assets. We're talking everything from stocks and bonds all the way to commercial property. You are in the driver's seat.
And you can see the difference here, can't you? Your workplace pension is brilliant. It's your employer's supported scheme. But a SIPP, well, that's a personal arrangement that puts you firmly in control of your own investment strategy.
Right. Let's get back to that big question we started with and bust this myth once and for all.
So the crucial point is you can open multiple SIPPs with all sorts of different providers. Now, this isn't some kind of loophole, it's a feature of the UK pension system. It's designed to give you incredible flexibility in your retirement planning.
But why would you want the hassle of more than one? I mean, it sounds like more paperwork, right? Well, for a savvy business owner or a contractor, there are actually some very compelling strategic reasons.
It's all about tailored strategy. For instance, imagine a small cafe owner in Manchester. She might use one SIPP for stable, long-term stocks, and then another one with a totally different provider to invest in a specific commercial property fund that her main provider just doesn't offer. It's all about creating options for yourself.
Okay, but this next part catches a lot of people out. Having more SIPPs means more power, for sure, but it also means more responsibility and definitely more potential pitfalls.
You'll want to hear this part. It is so easy to lose track of things. Each SIPP has its own fee structure, right? And those costs can seriously eat into your returns if you're not careful. It's also much harder to see your total retirement picture at a glance, meaning you might accidentally end up doubling up on the same investments across different pots. Diligent management is absolutely essential.
Now, let's break this down into the numbers you absolutely must know. This is where things get a bit technical, but it's crucial for staying on the right side of HMRC.
The most important number to have in your head is the annual allowance. For the 2025/26 tax year, that's £60,000. Now, this isn't a per pension limit, it's the total for all your pension contributions combined. Exceed this, and you could be looking at a tax charge.
And for higher earners, you have to be aware of the tapered annual allowance. If your income goes over these thresholds for 2026, your £60,000 allowance gets reduced, which makes tracking your total contributions even more critical.
Stay with me. This next point affects anyone who's planning a phased retirement. The moment you start taking flexible income from a pension, your annual allowance for contributions to SIPPs and other schemes like it can drop to just £4,000. It's called the MTA, and believe me, it's a trap many people fall into. And this brilliantly illustrates the main takeaway here. Whether you have one SIPP or 5, the buck stops with you. Your providers won't do the tracking for you. Keeping meticulous records is completely non-negotiable. So as you can probably tell, juggling multiple SIPPs, allowances, and tax rules isn't for everyone. It requires really careful planning, and sometimes professional guidance is the smartest investment you can make.
A specialist can help you see the bigger picture. We're talking about everything from making sure you're getting the right tax relief on your contributions to planning withdrawals in a way that doesn't create a surprise tax bill down the line.
So, the crucial point is this. While the flexibility of having multiple SIPPs is incredibly powerful, harnessing that power effectively often requires an expert co-pilot. Your retirement is just too important for guesswork.
Now please remember,
This information is for general guidance only, and it shouldn't be a substitute for professional advice. To discuss your personal circumstances and make sure your retirement strategy is on the right track, please don't hesitate to reach out to the team at My Tax Accountant. You can also read more on this topic on their blog. Thank you so much for joining us, and please consider subscribing to the My Tax Accountant channel for more helpful content.